Hey YouTubers, welcome back to my channel. In today's video, I thought we can look at what is going on in the markets in general at the moment. Because we have some abnormal activity, especially during such unprecedented times of the coronavirus stock market crash, and then the rise as well. Also, I thought it would be a good idea to take a look at what Warren Buffett has said about investing during market turmoil that we're currently going through. Now, during the intro video, let's have a look and see who can hit that like button the fastest. Ready, steady, go! So, first of all, let's take a look at the two markets that I mainly follow. And we can take a look at them over the last 6 months. So, you can see here on the left, we've got the FTSE 100. And this is the largest 100 companies in the UK. And on the right, we can see the S&P 500, which is the largest 500 companies in the US. In both graphs, we can see that in the last 6 months, especially when the corona pandemic hit us and we really started to understand the impact of it, around the end of February, early March, both markets started to fall drastically, losing almost 40% of its value, which all makes kind of sense as everyone went into lockdown and the economies completely went into standstill. Now, on top of this, besides all the help provided from the government, there is still a high level of unemployment in both countries, even in UK with a furlough system. This system can result in many people actually losing their jobs very soon, as all the companies, when they start coming back to normal, they still need to continue working at a reduced rate in order to reopen according to the social distancing rules. Now, there is also the added factor that when the economy actually reopens again fully, we could be hit with a second wave of the virus. But despite all this turmoil, the markets managed to bounce back up. The S&P 500 doing better than the FTSE 100, mainly because the large tech companies that are dominating the world at the moment sitting in the S&P 500. But one thing to remember here is that 5 of the biggest companies in the S&P 500, being Microsoft, Apple, Google, Amazon and Facebook, now comprise of almost 20% of the total value of the S&P 500. Therefore, if only those 5 companies do pretty well, but most of the other 495 companies don't do that well, the whole index could still look like that it did pretty well. This means that the index does not give a true representation of the economy. Now, this also entertains the idea that if the S&P 500 is heavily stacked towards 5 companies, there's a big chance of there being a market crash. Earlier this year, when the corona pandemic hit us, the oracle of investing, Warren Buffett, decided to sell all his airline stocks. Now, many people have come forward to criticize him for doing this, especially when a lot of these airline stocks went through the roof at the beginning of last week. Even the president, Donald Trump, said that Warren Buffett has been right his whole life, but sometimes even someone like him, who he has a lot of respect for, makes mistakes. But did Warren Buffett actually make a mistake? Now, last Thursday, the market started to tank again, where all those 4 airlines that Warren Buffett sold actually saw losses between 8% to 16%. But what actually made the market skyrocket in the first place? Well, in the news, it seems as though a lot of people are blaming the millennials. And it has a lot to do with these new trading apps in the world, the likes of Robinhood in the US. Then there's Free Trade and Trading 212 in the UK, which, by the way, you can find a referral code in the description below if you want to get a completely free share for your portfolio when signing up. So all these new trading apps are introducing commission-free trading. And some of the platforms like Robinhood are offering options trading, as well as Trading 212 who are offering CFD trading, which means contracts for difference. Now, both these types of trading is called derivative trading. That basically means that the value is derived from an underlying asset. Now, both types of trading is also leveraged. Now, leverage is what allows traders to operate with a significantly larger sum of money than what they actually have. So, for instance, if the trading platform allows you to do a 1 to 100 leverage, this means that if you deposit £100, you have the ability to trade with £10,000. Now, at the offset, this sounds amazing. With as little as £100, you can have the buying power of the richer people out there who can buy £10,000 worth of shares. Well, it's not really all bells and whistles, because that's great if you're 100% certain that the market will go up. But especially during this time, where no one really knows what is going on in the market, you can also use your £100 but end up losing £10,000. Now, this is the main reason why I don't trade in options or CFDs. I mean, don't get me wrong, there is definitely a lot of money that can be made, but there is also a hell of a lot of money that can be lost. And the way I see it, it's almost like my personal rule of Vegas. I would love to go one day, but I feel like I'll only enjoy it if I had a few grand that I'm just happy to throw away. Now, right now, in my life, I just don't have the time to do the necessary research in order to do short trades that you can benefit from with options or CFDs. Therefore, I'm sticking to the long game. Now, going back to what we saw previously, all these new trading platforms have seen a flood of new customers trying to cash in on this new generational buying moment, which is a very good reason as to why the stock market saw the fastest bear market. But not only that, this happened during the worst first quarter on record. Therefore, this wave of new trading from these apps have seen an abnormal amount of activity buying shares in companies driving their stock prices really high. Now, Robinhood alone serves more than 10 million customers, and according to RobinTrack, another company that is able to track the activity on the Robinhood app, it saw these new investors piling into stay-at-home stocks and stocks most beaten down by the economic shutdown. Now, these stocks included things like video conferencing companies, airlines, casinos, hotels. They also bought into speculative names such as Hertz and Nikola. Now, going back to Warren Buffett, did these millennials beat the guru of investing? In the short run, I guess yes, as they were doing short bets on the airline companies to bounce back. However, what day traders don't really take into consideration is the full picture of the company. Now, this is where Warren Buffett has built up the wealth that he has today, by truly analyzing companies and understanding what they do and how they do it. And the difference is that Warren Buffett truly scrutinizes the books of each company that he decides to invest in. Now, when he sold his shares in the airline companies, he did always state that there was nothing wrong with the way that the companies are being run. Nevertheless, he did still sell the stock. Reason being is because he understood how the whole market actually works. And in order for the airline industry to truly thrive, it requires heavily on the consumers taking flights. However, when the governments are not letting people travel freely, this causes a huge problem, especially when companies like American Airlines are spending $40 million a day just to cover basic expenses while we wait for the economy to pick back up to normal. And that's really the key point here. We don't actually know when the economy will be back to normal. And for one, we definitely do not know how long it will take until we can get back to whatever jet-setter lifestyle that we may have had before this whole pandemic. Now, I don't know about you, but my current holiday plans, they're looking more likely to be in 2021 rather than anything that I can see happening this year. Now, on top of all of this, we also have airline companies deciding to sue governments, like British Airways, EasyJet, Ryanair. They've all launched their legal action against the UK's government quarantine. Now, not knowing whether the market will go up or down is precisely why I have no interest in getting involved with trading with derivatives. However, during times like this, I believe there is only one thing we can do, and that's to listen to investing gurus such as Warren Buffett, who has lived and also thrived through multiple market crashes. such as Black Monday back in 1987, the dot-com bubble bursting in 2000, the 2008 financial crisis, and others as well. So here are a few of his best quotes of investing during a crisis. Number 1. We simply attempt to be fearful when the others are greedy, and we be greedy when others are fearful. Number 2. Like Cinderella at the ball, you must heed one warning or everything will turn into pumpkins and mice. Mr. Market is there to serve you, not to guide you. Number 3. Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. Number 4. Investors and managers are in the game that is heavily stacked in their favor. Now Charlie and I believe it's a terrible mistake to try and dance in and out of it based upon the turn of tarot cards or predictions of experts or the ebb and flow of business activity. The risks of being out of the game are huge compared to the risks of being in it. Now, I know some of these investing tips can sound a bit contradicting, but I'm treating the market currently as the time when people are being greedy. Therefore, I'm buying and holding companies that seems to have had not much impact from the coronavirus, but also I've decided to start building up a dividend portfolio as well. And top of all of this, I've been putting money into ETFs for the FTSE 100 and the S&P 500. This way, I will still continue to set myself up for my future in a few years down the line, but I'm not getting affected by the volatility of the near-term future. Now, as always, I don't have any financial background at all, and this is all just a little insight of what I think is going on in the markets from the research that I've managed to do. So if you plan to take on any of my advice, make sure that you do your own due diligence before going and investing yourself. But before you head off and start Googling the markets for yourself, why not hit that red subscribe button and make sure you click on the bell as well so you get notified when my next video comes out. And don't forget to share and comment. See you all on the next video.